Okay, so let's just state the obvious. We are living right in the middle of an AI explosion. The money, the hype, the technology, it is all moving at a breakneck pace. But, and this is the big but, beneath all that surface excitement, a really critical question is starting to bubble up. Is this the real deal? A new industrial revolution? Or are we just watching a massive, massive bubble about to burst? Let's unpack the source material and see if we can find some answers. $3.34 trillion. Yeah, you heard that right. For a brief moment, that was the value of NVIDIA, a company that, at its core, makes computer chips. It made them, for a little while, the single most valuable corporation on the entire planet, bigger than names you know like Microsoft and Apple. And that right there brings us to the core question of this whole explainer. How on earth did that happen? And maybe more importantly, what does it all mean for the future? Are we really building a new digital world from the ground up? Or are we just making the same spectacular mistakes we saw during the dot-com crash back in 2000? So to get to the bottom of this, here's how we're going to break it down. First, we're going to look at the sheer scale of this AI gold rush. Then, we'll introduce you to the key players in this game. We'll dig into the staggering physical costs of this revolution. And then, we'll start looking for the cracks in the financial foundation. We'll compare it head-to-head with the dot-com bubble. And finally, we'll try to figure out who the real long-term winners in all of this might actually be. Okay, first things first, let's just try to get our heads around the scale of what's happening. Calling it a gold rush is no exaggeration. The amount of money pouring into AI right now is unlike anything we've really ever seen before, and it's creating this almost bottomless demand for the tools to build this new frontier. The numbers you're looking at here are just staggering, and they tell a story of just exponential growth. Look at this first bar. In 2025, venture capitalists are projected to pour $200 billion into AI startups. That's over half of all VC investment for the entire year. Now, look at this middle bar. Just 1 year later, in 2026, total spending on AI is set to explode to over $2.5 trillion. And this last bar, this might be the most telling of all. By 2030, just the investment in physical data centers is going to hit an incredible $6.7 trillion. These are not just big numbers, folks. This represents a fundamental reshaping of our global industrial base. So, all this money, where is it actually going? Well, to understand that, it really helps to think of this AI boom exactly like the California gold rush of the 1800s. You had different groups playing very specific roles, and it's the exact same story today. So, you've got three main players in this game. First, you have your picks and shovels sellers, and that is dominated by NVIDIA. They're not mining for gold themselves, no. They sell the essential hardware, the GPUs, that everybody else needs. And for those who don't know, a GPU is a special kind of chip that's just insanely good at doing thousands of simple calculations all at once. That happens to be the exact kind of math you need to train AI, which is why NVIDIA's GPUs are basically the bedrock of this whole boom. Next up, you have the infrastructure providers. Think Amazon's AWS or Microsoft's Azure. They buy mountains of these chips, build these massive data centers, and then they sell access to all that computing power. And finally, you have the gold miners. These are the companies like OpenAI, Anthropic, and xAI. They're the ones actually buying or renting all that compute power to train and run their world-changing AI models. This really lays out the flow of money and resources perfectly. As the Plain Bagel's source material puts it, these infrastructure players are the critical middlemen, right? They're connecting the hardware from the chip makers to the software dreams of the AI labs. So now we know who the players are. Let's talk about the absolutely staggering physical reality of what they're trying to build. And this brings us to what you could call the $7 trillion question. What does it actually take to power this revolution? We love to think of AI as this weightless, magical code just floating around in the cloud. But the reality? The reality is that this revolution is a business of atoms. It is one of the biggest, most ambitious industrial projects in human history, and it's built on a very, very real foundation of concrete, silicon, copper, and an almost unbelievable amount of raw power. I mean, the physical demands are just breathtaking. Let's talk power. One source estimates that OpenAI's future plans alone could demand the energy equivalent of 26 nuclear power plants. And these data centers, they don't just pop up overnight. Building one takes years of navigating these complex regulations and massive construction projects. They generate so much heat, they need vast amounts of water and super advanced cooling systems just to keep from literally melting. And that's before we even get to the networking gear and the raw capital needed. That $7 trillion figure, that's more than a fifth of America's total capital spend across all industries in a single year. It's just wild. So this massive, massive industrial build-out, it brings us right to the central tension of the entire AI story. Because whenever you have this much money moving this fast, cracks inevitably start to show up in the foundation. And the biggest question becomes, is all this explosive growth actually sustainable? Or is it being artificially propped up? So, one of the biggest concerns out there revolves around this thing called circular financing. It's a little complex, but it's absolutely critical if you want to understand the potential fragility of the AI market. At its heart, it's a financial loop where money can just end up chasing its own tail. Let's just walk through it together. Step 1. A tech giant, like a Microsoft or an NVIDIA, invests billions of dollars into an AI startup. Let's say OpenAI. Step 2. That startup then takes that exact same money and uses it to buy cloud services or chips back from that same tech giant. Step 3. The tech giant gets to book that purchase as brand new revenue on its books. And the result? Well, the revenue numbers can look artificially inflated because the company is basically just giving its customer the money to buy its own products. The big fear here is that the pick and shovel seller, NVIDIA, is using its massive profits to fund the gold miners, who in turn create the demand for its products. It raises some really serious questions about how much of this demand is organic and real, and how much is just an echo in a financial chamber. And this leads us right into another major crack, the return on invested capital gap. There is a frankly terrifying disconnect growing between the money being spent and the money being earned. Just look at these numbers. The hyperscalers like Amazon and Microsoft, they're spending over $400 billion a year on AI infrastructure. But right now, that's only generating about $100 billion in new revenue. And it gets worse. Some estimates suggest AI companies need to be making $2 trillion in annual revenue by 2030 just to be profitable. For context, the 2025 revenue estimate is only around $43 billion. That is a massive, gaping chasm that needs to be closed. So with all these risks floating around, how does a company like NVIDIA maintain such a dominant, almost monopolistic position? Well, the answer lies in this powerful business idea called an economic moat, or what the source material brilliantly calls stickiness. It's when the costs for a customer to switch to a competitor, in time, money, and sheer effort, are so high that they're effectively locked in. And this right here, this is NVIDIA's secret weapon. It is the true source of their power. It's not just their chips, it's their software platform, CUDA. You see, for over a decade, an entire generation of AI developers has built everything, their applications, their models, their entire careers, on top of the CUDA ecosystem. So when a competitor like Amazon comes along spending billions on its own custom chips like Trainium and Inferentia and says, hey, use ours instead, it is not a simple proposition. For a customer to switch from NVIDIA, it is not a hardware swap. No way. It means completely rebuilding their entire software stack from the ground up, a process that could take years and cost millions in engineering talent. That software stickiness is NVIDIA's incredibly deep and wide moat. And it's the brutal truth behind why the much-hyped NVIDIA killer has yet to actually show up. All of this, the circular financing, the valuation gaps, the intense hype, it all naturally leads to comparisons with the dot-com bubble of the late 90s. I mean, even OpenAI's own CEO, Sam Altman, has said, quote, we're probably in a bubble. So are we really headed for a repeat of the dot-com crash? Well, the data tells a more nuanced story. So just take a look at the contrast here. While there are definitely parallels in the hype, the financial fundamentals today are really, really different. During the dot-com peak, as you can see, the S&P 500's price-to-earnings ratio hit an insane 46 times earnings. Today, it's closer to 30. Back then, 36% of tech companies were unprofitable. Today, that number is about half that. But maybe most importantly, today's major tech companies are generating 3 times the cash flow relative to their valuations. And while the dot-com boom was funded by speculative VCs and IPO hype, today's AI boom is largely being bankrolled by cash-rich, incredibly profitable tech giants. So, if this isn't a perfect repeat of the dot-com bubble, and this massive physical build-out is very, very real, then who are the ultimate winners going to be? Well, to answer that, we need to look beyond the flashy headlines and the famous tech companies. While the whole world is mesmerized by the magic of AI software like ChatGPT, the smart money is following the atoms, not just the bits. The real, durable, and maybe less risky profits might actually be in the boring, essential, physical building blocks of this entire ecosystem. Just think about it. Every single one of these AI data centers requires a staggering amount of electricity. This unprecedented demand is a massive boom for power utilities, who suddenly have this brand new, super power-hungry customer. These centers need sophisticated cooling systems from specialized companies like Vertiv. They need lightning-fast networking gear from firms like Arista to connect all those GPUs. All of this is built with raw materials like copper. Demand is skyrocketing, and it could eventually be powered by uranium for next-gen nuclear energy. And, of course, somebody has to physically build these massive facilities. That's where industrial engineering and construction firms come in. These are the hidden and maybe more durable picks and shovels of our 21st century gold rush. And that leaves us with a final, kind of provocative thought to chew on. We frame the AI competition as a race for the smartest model or the most clever algorithm. But what if that's completely the wrong way to look at it? The ultimate bottleneck in this revolution may not be software, but just raw physics. The real winners might not be the companies that write the best code, but the ones who can secure the land, the permits, the power, and the physical materials to actually run it all. The future of AI might just depend on who can keep the lights on.